Sponsored by Chartered Financial Strategies. You are now watching Tax Bites.
Welcome to another episode of Tax Bites. And this episode is another continuation in the series Tax Planning the Myths. And this is that second myth in the series of tax planning or of tax planning myths. And it is tax planning is not necessarily about managing your income tax, managing or reducing income tax on your tax return. Kind of implied that with regards to the previous myth, but more directly, this one is where a lot of tax planning has nothing to do with 1040 individual income. And a couple of scenarios are going to be one is estate. Estate planning is really a lot about how to manage someone's affairs once they've passed away. You know, how the assets are titled, how they are, in a trust, how they're titled in a deed, what type of accounts they have. All that stuff can have a wide variety of administration issues. Do you have to go to probate court, and that court may charge a fee based on the assets that are being probated? The fewer the assets, the lower the fee, things of that nature. And a lot of common tools that can be used are things like, for that, are trusts. And trusts are not efficient tax vehicles, tax types of tools, so to speak. And so, just to give you an example, is for a 24% tax bracket for an individual, married, filing joint couple, it's $170,000. Above that, you start paying 24% tax. On a trust, it's around $3,000. On a, for I think the 37% tax bracket, it's around $630,000 for a married, filing joint couple. For a trust, it's around $13,000. You can see the incredible disparity in income before you're suddenly paying a max tax rate on a trust. And so it's not meant to be a tax efficient vehicle. And that's its own myth, is that a trust is some great tax efficient vehicle. For the most part, they're not. I'm not going to say there are exceptions to that. For the most part, they're not. But the whole point is income tax planning or tax planning is not necessarily tied to income tax. It can be tied to other things such as estate planning and transfer of assets, ease of administration of one's affairs after passing, that kind of thing. The other scenario is kind of like liability protection. An attorney kind of leads this, but there's tax consequences. An attorney may say the type of business you're running is best done in a corporation and not an LLC. We want you to be such and such Inc. versus such and such LLC. Now, yes, you can tax plan around that through some elections and things of that nature, but the point being is that that type of discussion may lead you to a certain type of entity, and that's what you operate under. It has nothing to do with taxes. It has to do with liability, and there may be tax consequences or tax efforts at that. But that's not a 1040 income tax goal. Liability protection goal is the issue. Trusts roll right into that. For even people who are alive today use trusts to protect themselves from creditors even while they're alive. Has not necessarily had to do with when they pass. So there's all kinds of things that can be done from a tax or asset effort that aren't about the 1040 income tax. They're about other efforts. So the tax myth of today, or the tax bite, is, tax planning is not necessarily about reducing your income tax on a year-to-year basis. I hope that's been insightful and helpful. As always, like, subscribe, and comment, and have a good day.